If you've been watching my channel, you've heard me use the term startup bubble burst, and it's a term I made up, but I'm not the only one talking about this. So in this video, I'm going to define the term, talking about how it will affect the industry and how long I think it will last. If you are a subscriber or a regular viewer, thank you so much for coming back and checking out this video. But let's talk about the tech bubble burst in the 90s. Wikipedia defines the dot-com bubble as a stock market bubble in the late 90s. The period coincided with massive growth in internet adoption, a proliferation of available venture capital, and rapid growth of evaluations in new dot-com startups. Particularly in the mid-1990s, there was unprecedented growth in information technology and telecommunication services, where the cost of sending and receiving data dropped sharply. The massive adoption of personal computers and the adoption of the World Wide Web revolutionized industry, finance, trade, and services. Ambitious entrepreneurs put together plans to launch online businesses, and venture capitalists were eager to finance them, lured by potential profitability. The dot-com bubble coincided with the longest period of economic expansion in the United States after World War II. Inflation and unemployment were declining, and economic growth and productivity increased substantially. From October 1998 and onwards, markets cheered and seemingly endless IPOs of dot-com firms without paying much attention to the viability of business models. A financial bubble was inflating, and in spite of huge market capitalizations, one of these internet startups would never generate any profit or revenue. Doesn't that sound familiar? The Nasdaq rose to 86% in 1990 alone and peaked on March 10th of 2000 at 5,048 units. The mega merger of AOL and Time Warner seemed to validate investors' expectations about the new economy. Then the bubble imploded. As the value of tech stocks plummeted, cash-strapped internet startups became worthless in months and collapsed. The market for new IPOs froze. On October 4th of 2002, the Nasdaq index fell to 1,139 units, a fall of almost 77% from its peak. This should sound a little bit familiar from what's been happening. Stock prices are dropping, but let's rewind back about 10 years ago to 2013. A lot of startups that we are familiar with now had been founded by 2013, like Airbnb was founded in 2008, Twitter was founded in 2006, and Google had been around since the mid-2000s. DoorDash was actually founded in 2013, but 10 years ago, 2013, there were a lot of young startups that were proving to be very profitable. Like Airbnb started hopping up in 2013. DoorDash proved to be a successful company, and between 2013 and 2019, a lot of small startups that had no proven revenue, like Twitter, were still receiving a ton of investment. It was actually really trendy to be someone who maybe they had a ton of money from their stock package at a big company, or they themselves had founded a startup and had a ton of equity on their hands. There was a lot of free giving to startups and funding for startups that had potentially good ideas without proven revenue models. And that sounds a lot like the dot-com burst, where particularly they were saying that in spite of huge market capitalization, meaning in spite of being able to get funding very easily, most of these internet startups would never generate any revenue or profit. That sounds just like Twitter, and there are a ton of startups, and I mean really a ton of startups that don't produce any revenue. Now, generally speaking, a lot of startups will not produce any revenue or profit for the first 5 years. There are startups that have produced revenue or profit in that time frame, but not a lot is to be expected in the first few years of a company. That's a huge investment. But I mean, before COVID happened, it was really easy to get people to invest. There was a bit of social clout for people who were investors, venture capitalists that were investing in these startups. And a lot of them did see a lot of profit when that happened. Like with Airbnb, early investors saw a lot of profit when the company IPO'd, along with early employees with the company. So there was a lot of reason to think that funding startups equaled future wealth. And because of the easy funding that a lot of these startups could get, tons of startups popped out of nowhere, and a ton of startups that didn't really have any reason to exist, particularly social media startups. There's some social media app that has like a red cup for the logo. I think it's like Hangouts. It's something about sharing video rooms with people, but there's no profit model in that company, yet they had so much funding that they could salary compete when hiring new employees. And that is the tech culture that most people in tech came up in or have most of their experience in. A time where a lot of startups had almost endless funding, and with that endless funding they could seemingly offer an endless amount of salaries. I saw tons of startups that had no profit whatsoever, easily adding 20 to 30K onto salary offers in order to snag what they thought was the best employee. I mean, I met people who had barely 5 years of experience. They came up with an idea that other people thought was good enough. They had tons and tons of money with little experience on how to handle a startup in a less ideal recession, but there kind of was this attitude that it would never stop. And there is a lot of attitude with people in tech that tech is untouchable to recessions, that there will always be a demand in tech. Well, there's a context that's needed there. The internet is still very new to humans. It hasn't really been around that long. We have a long way to go before we understand the impact of the internet and personal computers on society. And we have a longer road in the same way of seeing ups and downs in the tech industry. What I call the startup bubble burst is similar to the dot-com burst. Tons of startups came up in a relatively small amount of time that got easy funding because there was a lot of clout around startup funding, a lot of proven success in startup funding. So people somewhat threw their cash in the wind, and a lot of them saw that money come back. But then COVID happened. The entire world stopped. Every company had to go from working from home, and a lot of companies focused in the service industry simply had to lose money. In 2021, we saw a great bounce back from that. What people thought was the economy missing a recession entirely. A lot of people genuinely believe that stimulus checks were helping the economy bounce back and that we would see no recession. So in 2020 to 2021, the stock market went absolutely crazy. A lot of people threw those stimulus checks right into the stock market, and a lot of stocks exploded. I personally know people who have a moderate to low level of intelligence that were able to buy a house from their earnings from stocks. And that is a once in a lifetime experience that people did not realize was not a forever thing when it was happening. But similar to the dot-com burst, before the startup bubble burst started, stocks were going crazy, salaries were going up, and it had seemed that these startups who had easy funding were not at threat of losing that funding. But 2022 came along, and finally the COVID era recession hit the economy. We saw tons of layoffs happening from large companies I would not consider startups, and now we're in 2023 seeing tens of thousands of people in tech being laid off. Startups now are having a harder time finding funding. Partially that is because the interest rate of funding has increased in the same way that mortgage interest rates have increased. It's also considered more risky to invest in startups now. If you watch my channel, you know that I've been doing layoff videos, and I've seen a lot of layoffs in companies like investment companies, healthcare companies, social media companies, and I mean, particularly healthcare startups was a very popular area of the startup era, but those companies are currently laying off and going out of business. That is what the startup bubble burst is. It is one, startups are having a hard time finding investments and funding from outside sources due to a smaller availability in cash from venture capitalist funders and a bigger risk of the economy. Two, the economy is shrinking, so more people are less willing to pay extra for special services. Particularly, a lot of these healthcare companies are biomedical companies that are trying to research bio information to predict future illnesses. Well, in a recession, people aren't so concerned about predicting future illnesses as much as solving the present problem of not being able to afford healthcare, not having enough patients to pay for healthcare employees. And three, I think that the clout of investing around startups has almost completely disappeared, or certainly will disappear soon. Before you were able to invest in startups, well, you were basically rich already. But now people who are investing in startups are considered risky, and the choices that they make need to be more heavily weighed. And I don't know about you, but I don't know of that many small startups starting that don't have either an industry veteran name attached to the label, a larger company attached to it, or a substantially good idea. For example, DoorDash, founded in 2013, they've done a lot of layoffs and they're seeing a smaller number of revenue because less people are using DoorDash. Let's be honest, we're in a recession. Eggs are like $9. A dozen eggs are $9 in some places. So people are not going to be able to afford these extra services. Another startup that had a special platform for buying eyeglasses where you could see the glasses on your face before you buy them, they went completely out of business. And that might be because as we're in a recession, people who do need eyeglasses are going to wait longer to buy those when they have better financial standing, or people who don't have glasses and need them might be waiting to go to the doctor because they can't afford the healthcare. So if you are someone that's wanting to look for a job at a startup, I caution you, please be careful. A lot of the startups that have been founded this year have a lower chance of success than they would have before COVID. Now, standing startups, we haven't even seen the peak of the startup bubble burst. I think it's going to happen this summer. So if you're working at a startup and they're not producing a considerable level of profit, you might want to shake in your boots because it is likely that they will lay off. They will try to reduce the costs of employees or overwork their employees, or just try to reduce the margin on their products so they can stay in business. And if you are wanting to found a startup in 2023, I mean, best of luck. I hope you have a really great idea. And if you have the idea before you have your funding, please slow down, get the funding first and develop the idea later. If your dream is to be a startup founder and you freshly graduated college, you want to go straight into I'm a startup CEO like people did in 2017, I caution you to be a little bit more pragmatic in your choices and consider trying to get a job in the industry first. There's not a huge chance of success. There's not a huge chance of investment for your idea. I do think we're going to see a slowdown in the 24-year-old CEO of startup.com. As we move into a recession, old school mentalities will return. People will want to see those in leadership being veterans in the industry rather than young, smart, great potential people running a company. And if you use this term, the startup bubble burst, please share this video with other people because I deserve recognition for making up this term, but also, and it gives more people information basically explaining how we are repeating the dot-com burst. And this time, instead of being focused around particularly web technologies, it's now focused around startups that don't have any profitability and they're providing a product or service that is not essential to the economy. And that's what I want to leave you with this video. Startups moving forward need to have a real product that solves a real problem, not a possible problem, or not offering a luxury service like Airbnb. A new report came out that in October 2022, 66,000 new Airbnb listings were listed on the website. October is not a hot month for Airbnb. It's usually the summer when people take summer vacation. Sure, maybe around holidays, but that's an impressively high number, which indicates that luxury services like Airbnb are becoming less and less needed. I expect that to continue into the next year. When do I think the startup bubble will burst? Well, I am not the expert and the person that you should say knows everything about that. I'll be quick to say that, but I would suspect that we won't see it in this year, 2023, maybe in 2024. Things will slow down, but people are still in a fantasy land that the recession isn't real, or in the fantasy land that the dot-com burst can't happen again. Well, it's happening again. It's just a little different. Similar to how a housing market crash is coming again, but it's a little different because it's not based on the subprime real estate lending issue. I think now it's based around Airbnb and the real estate investor popularity in culture. Again, I'm not a real estate expert. I just know a lot about getting a job in tech and hiring in tech, so that's where my expertise lays. If you are trying to get a job at a startup, please heavily consider the usability of the product or service that they're using. Please temper yourself on salary expectations, as these startups don't have the same funding that they would have had in 2017. And if you currently are working at a startup, consider opening up your job search on a casual basis in case the profitability at your current company is not keeping pace with the years before. And if you are currently employed, please subscribe to this channel. I'll give you lots of updates on the tech market, how things are changing at getting jobs in tech, and what your future could look like, and what your future career could look like going through the next 2 years. I do think that by 2025 and 2026, it will be a better time to start up. So if you have a dream startup that you're thinking of starting, consider developing the product, platform, technology, or whatever service it is that you want to create while you still have a job, and plan on launching it after the peak of the burst or the peak of the recession. Thanks for watching this video. Please subscribe to this channel. Share this video with someone that you know that's a new CS grad that wants to go straight into startup CEO like their older brother did in 2017 or 2016. Please comment and let me know your thoughts about the video. I'm glad to hear when people say that I'm wrong. It does adjust my videos going forward in the future. And if you think I'm wrong, please bookmark this video so you can check it out this summer. Thanks for watching this video, and I hope to see you in the next one.